people would go into a bank to cash their checks and
hmm
make deposits. And I was standing on the other side of the counter taking the checks and deposits. And I would see on the computer screen, how much money people had in the bank. And
hmm
it was remarkable. I mean, it was obvious. The wealthiest people that I interacted with owned real estate.
hmm
That was it. So then there's a story in my head, the old, it takes money to make money. You got to be rich to do this. But when you just described kind of that niche that you're in, where you're talking $2 to $10 million properties,
hmm
and if you're assembling a group of investors, the question is, what's the check size that people are writing? I'm feeling like it's approachable for a lot of people.
Totally. Yeah, great
Yeah.
question. And that is our whole mission, right? Is not everyone has the time to be investing in real estate. And a myth about real estate is that it's passive income, and
Mm.
it's not passive. It's a lot of work, no matter what type of real estate, unless you are investing in what we call a syndication.
Welcome to the Value Factory Podcast, brought to you by One Accord. We're all about helping businesses thrive and grow through leadership, strategy, and meaningful impact. Now, whether you're a seasoned executive or just starting out, our goal is to provide insights and inspiration to help you navigate your journey. Thanks for tuning in.
Well, welcome everyone to another episode of the Value Factory. I'm so pleased, excited to be sitting with Lauren Rogers with Veritas Equity Partners. We're going to talk all things multifamily investing, fundraising, specifically in projects in and around the Pacific Northwest. I'm excited to talk because you've just, from my perspective, blown up on LinkedIn with like wonderful content, like really meaningful content. And even one of your most recent posts was kind of like, why post on LinkedIn? And you talked about having raised funds from just a couple of posts there on a project. So lots to talk about. Thanks for being here.
Well, thank you so much for having me. Yeah, I'm excited to talk to a fellow Pacific Northwest business owner and get to share a little bit more about what we're doing at Veritas Equity Partners as we're growing and scaling. So we're about 2 years in now. And yeah, would love to just share more about our vision and what we're up to and how we've gotten this far.
Cool.
Yeah.
Well, let's start there.
Yeah.
The vision.
Yeah.
When I said let's start there, you said like three things, but vision. We'll go Stephen Covey, start with the end in mind. What is the vision for Veritas Equity Partners?
Good question. Our vision is really to take care of a select group of investors. So our long-term goal is not to be Grant Cardone or some institutional level fund. There's a point also though that we're trying to grow to, that we are not, there yet. So we are really focused on continuing to buy in Washington. That's where our past 15 years of experience has been, specifically in workforce housing. So think like median rent, maybe a little bit lower, providing affordable housing to our communities as things here just get more and more expensive. And I can kind of talk about, more about our thesis but I think our goal is to own, maybe by the end of our business, $1 billion worth of stuff in Snohomish County that doesn't deviate from our strategy right now, which is $2 to $10 million, think 20 to 60 unit buildings if we're taking into account Eastern Washington and some of the other places that we also buy, but staying in that type of building that's above mom and pop investors and below what's interesting to institutional funds that need to place hundreds of millions of dollars a year. And so we've just kind of found this niche of real estate that's overlooked, but pretty much unanimously people say that is actually where the best returns are. As we talk to really sophisticated operators that are doing much bigger deals, they will acknowledge, yeah, our deals are skinnier, that's because, we're working with newer stuff and we just don't need, a
Yeah.
15 to 20% return. We're not underwriting to that. So it's just a different business model. So operating in this smaller space has been advantageous so far, and I think it will continue to be just based on some of the supply constraints and different aspects of our region.
It's so much good, like so much gold in there. If I start with what I'm connecting with is Washington State.
Yeah.
Is that
Yeah.
that's the border, that's the territory?
That's our buy box. Yeah,
Yeah. Okay.
we only buy in Washington. We do have some stuff in Eastern Washington, Tri-Cities, Wenatchee, Walla Walla, and we will still pick things off there opportunistically. I think that region is also growing. There's some
Yeah.
data center stuff happening.
Yeah. Big investments.
Still very
Yep.
interesting, actually, play in Eastern Washington. My business partner, who's doing this for 15 years, transacted out into Eastern Washington probably starting 6 years ago, just because of some of the things that were happening in Seattle,
Mm-hmm.
the direction of the landlord laws and whatnot. And then that market ended up taking off.
Can we go there?
Yeah.
Can we go there? Washington. What about Seattle?
Yes. So I think what's important to note is different counties, different cities, the way government works, it's not all the same, right? So
Yeah.
people kind of tend to say, like, oh, blue state, I don't want to invest there. I want to be in Texas and Alabama. Well, look at where the Sun Belt is right now,
Yeah.
because you have endless land. So sure, you do have somewhat easier landlord laws, but when you compare specifically to Snohomish County, which is really where our focus is, we're buying in Linwood and Marysville and Everett. And, it's for those who aren't from Washington, that's 20 minutes outside of the
Yeah.
city, but you're dealing with dealing with different laws.
Yeah.
So aside from some of the broader landlord, now we do have rent control.
Mm-hmm.
People don't think fondly of that. The reality is neither do we, because it doesn't help the people that it's intended to help. It's
Right.
already massively reducing supply. From the aspect of our business, that's not a bad thing. So we don't see it as detrimental. It's actually kind of an advantage, although I still wish that that wasn't the
Yeah.
case, because I don't think it really serves anyone, from the business owners or the landlords to, the tenants who want to live there.
The I feel like I can go a little farther out on the limb with some of my opinions around these things. You're in that space, like you you get to deal with cities and counties, more than I do, because I'm not a real estate investor in the same context. So um I just can't imagine buying anything in the city of Seattle right now.
Yeah.
It just seems like not right now. Um And I can't ignore the fact that that's where so many of the jobs are today,
Mm-hmm.
and that workforce housing is just on the other side of the city limits, just 20 minutes outside, and they're commuting in,
Mm-hmm.
and so that Snohomish County, Pierce County,
Mm-hmm.
still, South King County,
Yep.
these areas in and around the cities that are, potentially amongst the highest in the nation with payroll taxes. And
Mm-hmm.
my perspective, and particularly with, the Value Factory podcast, is speaking to the owners and operators of businesses.
Mm-hmm.
And so, I find myself aligning with those operators and looking at uh, regulations and the regulatory environment with a high degree of scrutiny.
Mm-hmm.
But I'm making this connection that, a pathway to long-term wealth protection, creation, preservation
Mm-hmm.
for many business owners is investing in real estate.
Right.
I'm going to say this way more plainly. When I was a bank teller at 17 and 18 years old, the rich guys and gals that were coming into the bank were business owners and real estate investors, and not two different people. They were the same.
Mm-hmm.
The money they made from their business, they put into real estate investments.
Mm-hmm.
Some of them were those mom and pop operators.
Mm-hmm.
So they're running a business and then they own a fourplex or an eightplex and they're managing all of that.
Mm-hmm.
That sounds crazy to me.
Mhm.
Like I couldn't for the life of me think about doing that. But for many, they were investors in a variety of projects and often in kind of a local community. Are those the folks that are investing with you? Maybe some of them?
Yeah. Yeah. Our investors tend to be, I mean, it's a little all over the map, right? But lots of business owners now, also business owner, but also an attorney or a doctor, right?
Hmm.
But that's a business owner, obviously.
Yeah.
They own their practices, tech employees, and all sorts of other business owners too. We have, oddly enough, construction people. I mean, construction here right now is tough to pencil. They still want to benefit from depreciation, so they still like investing in real estate.
Yeah.
They understand the numbers, which is very validating, and they're
Yeah.
looking at it and saying right now it makes more sense to invest in existing assets and get my tax benefits that I want as a real estate professional. So we also serve a lot of real estate professionals. I'd love to see more of those people heavily invest in real estate
Hmm.
because they can actually utilize the depreciation fully.
You're saying, yeah, like Ariana,
Hmm.
my wife, you know that, but I'm saying that for the audience. She is what is deemed a real estate professional.
Hmm.
More than 50% of her time
Right.
is focused on actively managing our projects.
Right.
Not everyone is able to take that passive depreciation against active losses. And we
Yeah.
might be going down a little
Yeah.
rabbit trail
A little
here, but
CPA, like, yeah,
yeah.
note, I am not a CPA. This
Yeah.
is not financial
Disclaimers,
advice.
disclaimers, yeah.
Yeah. But,
But what you're
yeah,
saying is that
yeah.
there are people for whom that depreciation has a higher economic value in the present
Yes.
because they can.
Yes.
Yeah.
I mean, I think the majority of those people, at least the ones that are doing very, very well financially,
Yeah.
hopefully are investing in real estate. I think a lot of them are. I mean, we have our broker in our deal, our insurance agents invest with Veritas. So obviously a lot of these people get it, right? And they
Yep.
do that intentionally. But even for people who, I think tax benefits, even for non-real estate professionals, still very powerful because you are at least offsetting the cash flow. So let's say we're giving between 6 and 9% on your money a year. Well, that is not taxed because we have enough depreciation from the building to show a negative
Hmm.
K1.
Yep.
So now when we sell the building and we're kind of then hitting that 15% plus IRR, that's long-term cap gains,
Yep.
unless you 1031 it, which is the other, I think, really wealthy people in real estate
Yeah.
that I've talked to that have these massive portfolios that started out very small and it seems impossible. And then kind of all of a sudden you hit this place after, 10, 20, 30 years of just constantly 1031ing your money,
Mm.
and they're sitting on really massive portfolios.
Yeah.
So, yeah.
There's a lot of different rabbits we could chase down trails here. I get fascinated. Like I don't know, I could spend hours in that. Um, what are all of the opportunities for an investor leveraging real estate? But I go back to that 17-year-old self, and it used to be back in the day. Some of our clients are going to understand this, but the next generation isn't. People would go into a bank to cash their checks and
Hmm.
make deposits. And I was standing on the other side of the counter taking the checks and deposits, and I would see on the computer screen, how much money people had in the bank. And I
Hmm.
just, it was remarkable. I mean, it was obvious. The wealthiest people that I interacted with owned real estate.
Hmm.
That was it. So then there's a story in my head, the old, it takes money to make money. You got to be rich to do this. But when you just described kind of that niche that you're in, where you're talking $2 to $10 million properties,
Hmm.
and if you're assembling a group of investors, the question is, what's the check size that people are writing? I'm feeling like it's approachable for a lot of people.
Totally. Yeah, great
Yeah.
question. And that is our whole mission, right? Is not everyone has the time to be investing in real estate. And a myth about real estate is that it's passive. income, and it's not passive. It's a lot of work, no matter what type of real estate, unless you are investing in what we call a syndication. So we go and get a group of investors to put money together to buy a bigger deal. Those bigger deals, you need to kind of get over, like I said, the mom and pop, those sell for a lot because someone's willing to overpay, because quite often they're more of a novice, new real estate investor. So they're not underwriting the deal the way with the sophistication that we would. And also just number of units, right? So you have a little more leeway with vacancy and unit turns and things to go sideways when you have 20 units versus one, which is why I really caution people against, single family rentals with one tenant in there. Hopefully you get a great tenant and they just renew. But even when you look on the cash on cash of those, it's usually pretty light, unless you have a home that's like fully paid off and you inherited it from your parents, and you're just cash. There are certain things that can make sense. But also, if that person decides to stop paying rent and you happen to be in King County and it takes you 2 years to get them out or something horrible, it's very risky to not have to be able to spread it across a multitude of units. But our mission is really just to make it totally passive for people. We have a huge demographic of people that we are a fit for who have high paying jobs. They're really busy. Not everyone is capable or wants to be managing real estate properties on the side, although that's what we did. It's incredibly hard to work, at AWS and manage hundreds of units, and to do that really, really effectively to where you'd be getting your maximum return, I don't think is possible. We tried, and that was our personal money, so it's fine that we didn't totally maximize the returns, because the beauty of real estate is you can still build a ton of wealth and do great, and we did that, right? But now it's like, okay, if you have someone who really understands how to operate and how to buy right and how to operate effectively, you should be able to do it passively, and I think that is a better solution for most professionals.
And I agree. And I would say, full disclosure disclaimer, I'm not an investor in any of your projects, say maybe yet. And so with that, I can say that my endorsement of what you're saying comes from a place of like integrity. There, when you say not a lot of people want to be active and really, I mean, we're talking less than 1% of people walking around on Earth actually want to be managing real estate.
Well,
right?
and if they tried it, then they pretty quickly change their minds too.
Yeah.
So, yeah.
It's, it's late night calls with broken water heaters. It's rent doesn't come in. I mean, God forbid there is a really challenging, tenant situation, the risk that's there, the maintenance. I mean, it's not for the faint of heart. And yet there's so much opportunity there.
Right.
So to be able to passively invest. You talked about cash on cash. So you said numbers like 6%. So for round figures, I don't even know if this is realistic, but I put in $100,000 into the fund. A 6% return on that is $6,000.
Right.
If I put that $100,000 into a 10-year treasury, I don't know what the rate is today, call it 4.5%, probably in that ballpark.
Yeah.
And people would say that's a risk-free rate of return, the treasury. I'm not going to lose the money. On the real estate side, what does an investor want to look at to protect that 100,000 that they invested, but also ensure the probability that 6% is going to continue to happen year after year?
We should do a whole episode on this, actually. Like what to ask your syndicator or fund or whatever you're using for passive real estate investing. I think that, one, syndications, going in with a group of people, the returns are much better than like a DST or a REIT.
What's a DST?
It's like a real estate fund, essentially. So you're getting, I think they're like between 7 and 9%, but you don't have all the benefit. You don't necessarily have all the tax
Oh.
shelter benefits of an owner.
Gotcha.
And
So it's not a pass through. You're not getting a K1 at the end of the year. You're more investing in a fund and getting a return,
correct.
as with the REIT.
Yeah, it's
Yeah.
similar
Gotcha.
to that. And so people sometimes, if you can't find a property to 1031 into and they don't want to pay their cap gains, you might go into a DST.
Oh, okay.
That is an alternative. And I think a lot of brokers push that because it's a little more assured than identifying your next property, and 1031ing takes a lot of work. And that's another sweet spot that has kind of been unexpected that we've found ourselves in, is people who are wanting to transition out of whatever real estate thing. You can get out of a strip mall or an office building or another apartment building and tax free, if you get a bigger loan, put that into a new real estate investment. But if 1031s are a little bit tricky, so you have a certain amount of time to identify your properties, and then you have a certain amount of time to close on them. So there is a little bit more risk involved. And that's where we've found that we have a sweet spot coming in and helping people find those properties. We have very tight relationships with brokers. So we're making sure we're identifying something that's not going to fall through. And the returns are much better.
And here's one where I can speak to actual experience. So as I'm not an investor in your fund, I actually bought a property from an investor in your fund who is 1031ing it, and working with Alex, your partner. I would just say, working with Alex is a breath of fresh air.
Yes.
And
yes, it is.
And I'll just say, it's not because he's like the most flowery, he's a very nice, caring guy, but he's just like, get to the point. Here it is. He goes, I don't really care about the rest. Just tell me what I can count on. And I'm like, thank God for you, right? Just a straight talk, no BS, get there. And he's been really helpful for Ariana and me also, just as I'm looking at deals and things that I'm doing. Cost segregation analysis was something I've never done before. And so the resources that you guys have at Veritas, 1031, cost segregation, tax planning, those are really valuable to your investors. But that question of, what to look for in the kind of the operators, right?
Yes.
To ensure, because really, I'm giving you money, I'm giving you cash.
Yep.
And you're going to go do something with that. And I'm hoping you're going to send me a check once a quarter, once a year, whatever that looks like.
Yeah. I think the big, okay, a few big things, right, would be one, the debt. There's operators that do hard money loans. There can be reasons for this, especially if you're investing in construction or, let's say, a hotel conversion, something a little bit more nuanced. You were initially saying, workforce housing, pretty recession proof.
Yeah.
And consistent. So, like, talking about the treasury, I would say, in terms of our real estate investment strategy, pretty similar, hard to lose, because we are a more bread and butter investing in existing assets. We're not dealing with permitting. We're not building, it's not sitting empty for 2 years. Like, those are hard things to forecast. I'm not saying there's a lot of ways to skin the cat in real estate, but the debt is incredibly important. Every investor should certainly understand that and be asking the person who's the the GP, the operating partner on the deal, how are you ensuring that I'm not going to lose my money? Because that is worst case scenario. Unfortunately, it does happen. And it's usually people we're even seeing it right now. I think in other markets, I'm not seeing truly distressed deals here in Washington. But some of these operators that went out to Texas and Arizona and this big boom and all the migration trend, they were chasing trends, right? They got 3-year debt. Well, now interest rates are higher and they can't cash flow their deals anymore. They probably overpaid for them to begin with. But my stance is, if you get long-term debt, so we get 7 or 10-year debt, you should be able to pretty much ride any cycle. And our buildings are always cash flowing. So at a certain point, if we had to refinance, that's not our business model, but there's options. And when you're putting 30% down and you have a fixed rate and you have 10 years to execute a business plan, you're pretty protected. And then there's workforce housing, so people move out of A-class buildings when they lose their jobs. Ours are typically full. Like our vacancy is very, very low because people are, maybe Section 8, they're trying to move up into our buildings. People who
that's good.
lose their jobs move down into our buildings. We're right in the, so we don't need top tier rents for our deals to do really, really well. We just target median rent, maybe a little below that, obviously depends on the deal, but we know that those are pretty conservative. So big thing to ask, I think the biggest thing to understand is the debt strategy and the exit strategy, like what are you working towards? Well, we're working towards a sale around year 5. And that's based on, we buy a building, rents are low. There's operational inefficiencies. Sometimes we're getting like income statements on napkins, like the stuff that we have seen.
It's real. It's real.
Is crazy. Or quite frankly, Nepo kids that inherit buildings and think to themselves, like, my parents left me this piece of shit. I don't know how else to say it. And
that's
we're
it.
looking at, the average person would be like, my gosh, that's what I worked for my whole life for my retirement. But to them, it's like, I just want the cash.
Headache and a heartache,
and they're not going to take the time to go in and do all the renovations and bring rents to market rent. And, on the other side, who we sell to, well, the people who want that, right? Family offices are wealthy people that are like, I want a stabilized building that's just going to cash flow 9% for me in an appreciating market. And so that's who we buy from and who we sell from, but pretty hedged on all sides.
So I go to my credit underwriting and put on my lender hat, and I'm hearing low leverage. So you bring enough cash into the deal, which is great because that creates room for more investors, right? When you need more cash, there's more people there. Conservative debt, and you're taking out, or you're not layering in additional risk. So if it's a big reno project where you have to count on vacancies, that's a layer of risk. If it's a construction project, permitting delays, expenses, cost overruns, that's a layer of risk. Going into a new market, the growth market, you're betting on the come, that's a layer of risk. Because you peel back these layers of risk, you get closer to that risk-free. Now, nothing is ever as,
there's always risk
There's
in
always
investing
risk.
in absolutely anything. I do think the risk in this type of investment is lower, but questions to ask also, like, what's the insurance policy? Some, in order to inflate your returns, you want all your costs to be low, right? So things like insurance, that's a place where operators can cut corners. They might have like $1 million
risk.
deductible because they wanted it to be really low, so it looks like it cash flows better. There's these little tricks that are kind of scary when you get into it.
So when I would underwrite multifamily, the banks that I worked for would just have standard kind of plug figures for management, for vacancy. It's like, we would say, okay, you're telling us what you think the numbers are, but we're going to go over here and we're going to put in these figures and try to discount NOI to a number that we think is probably below conservative, right? And then we're going to shock test it with a 300 basis point increase on rates and try to make sure it all fits in there, which is why some years ago banks were only advancing like 50%,
right?
LTVs, because they were just hammering NOIs down. Back to the kind of start of that question, vacancies and management. You addressed vacancies, and I actually like there's a there to what you just said. When you're in that middle band,
Mm-hmm.
there are people that want to move up into your properties,
Mm-hmm.
but there are also people that need to, step down into your property. So you've got conceptual demand from both sides,
Mm-hmm.
right?
Right.
Brilliant. Management.
Mm-hmm.
That's where I'm going with this.
Yeah.
Management. Who manages your properties?
Yes. So we took our stuff in Snohomish and Pierce in-house
Hmm.
about 6 months ago to just try to be more efficient with everything. So, and that has been going extremely well, like
So you have a
strong.
property management company or division or
Right.
yeah.
Yeah. Property management. We hired someone strictly to oversee property management of our own stuff.
Yeah.
So it's not external. We've toyed with that, but we'll see, where that goes down the line. Right now, it's just about absolutely maximizing our portfolio. It is another place where also we have some buffer, right? We don't have to take fees on, we don't have to charge 4% for our work. We do because we need to pay our property manager.
Right.
But the standard rate, some of our buildings before we took it in-house were at like 10%.
Yeah.
So
yeah, I'd say 8 to 10 for external, like third-party property managers is not unreasonable.
yeah, that's pretty standard. You might get it a little bit less than that, but also our job is to be the asset manager. And so we spend so much time babysitting the property manager that it turned into, I would just love to have control of this.
Well, and there's, here again, I harken back to my banking days a lot. One of the divisions of, I ran teams that served property managers, and large property managers. And if I said the names of these firms around here, you would reckon they're managing, 3, 8, 12,000 doors nationally, locally, right? And so that 8 to 10% number is not unreasonable when you factor in, it's $75 for a service call, and it's paying here and there, and it's, every like it's a business. And for the property management firm that's what they do, they need to do that.
Right.
Like you
I
said,
get it.
you have to pay your
I get
property
it.
management firm.
Yeah.
But when you're giving that externally, you're paying for the
A huge
margin
premium. Yes.
for the owner operator of that company. Whereas when it's internally, you're vertically integrated and you have more control over the final product too.
Yeah.
Right?
I mean, it's very true. I didn't even call that out, but it's a great point that property managers, not only are they charging a higher fee than we charge our investors on our own deal, but you don't really know the cost of so-and-so's brother to come out and do whatever work was done. It's $20 an hour, but you get charged 60.
Yes.
And you just have no control of that because the invoice is the invoice, but that is a place where unfortunately some property managers really take advantage, and it's just kind of part of the business model.
Yeah.
They're also not incentivized enough to really operate the business well. I think the whole property management model needs to change. It's a business idea for someone because it's like they don't care. It's not enough money to them to get rents up $150 that year or to decrease expenses by X amount. It's just once they get your building, they're pretty much on to the next building, so you've got to create some sort of structure. And that's very hard to do. And I don't really know anyone who's done. I mean, we've been through a lot of property managers. So it just turned into, we luckily have good partners in Eastern Washington. And so that is going to remain for the time being because I do think it's hard to property manage when you're not there.
And for those not in the state of Washington, Eastern Washington is on the other side of a mountain range.
Yes.
So it's not just like 2 hours down the road, up or down I-5.
Right.
It's it's a thing. And to our earlier conversation, Washington state could be divided into 2 states as the mountain. So it's two very different markets, 2 very different demographics and populous cultures. All of that.
Very different. So we have a wonderful property manager in Wenatchee that's Wenatchee specific.
Yeah.
That does have huge advantages when it comes to, another reason to invest with a syndicator is you can do things at scale, right?
Yeah.
So we have better rates, we have better relationships when there are repairs. And that's true of property managers that are region specific. They have 1,000, 2,000 doors. And so they really matter to all of their vendors in that region. And that is a benefit, of working with Veritas too, right? We have relationships with brokers. We buy at scale. We're a lot more interesting than Joe, who's a real estate investor who buys one property every 5 years. We get the better deals sent to us first. That's just how it is. And it's
That
the
is just
same
how it
thing with
is.
vendors. They don't screw us over because they want to do the renovations on our next building they already know because we told them is 2 months down the road. So they're going to give us, they're going to be fair because we're going to provide them more business. So it's just everything kind of economies of scale.
Yep. Economies of scale. I was thinking that. So on this topic of, different markets, and then kind of bringing it back to Seattle,
Mm-hmm. Mm-hmm.
and you mentioned rent control
Mm-hmm.
earlier, is like, I actually don't even believe that we have rent control in Seattle. Like, I don't want to believe this. Like, rent control to me is like New York, like
Mm-hmm.
New York City and Berkeley, California.
Mm-hmm.
Those are the only. What is rent control? Like, what is this?
So rent control we did pass statewide, which is hilarious. I don't even know if I should say this, but we've talked to people politically here that hold political offices that didn't know that we had passed statewide rent control, which is very concerning. And I'm like, okay, we have a huge housing problem and that gets a lot of headlines. Microsoft just released a report on it. Big employers are trying to address it.
Yeah.
It's a big topic for our state. You would think that policymakers would really do their homework on this and research and see what's happened in other regions where they have rent control.
Bless your heart. you you think politicians? Yeah,
I know,
that's
right?
cute. That's cute. Sure.
We love our lobbyists. I'll just say that the people who really do the dirty work, which is not me, but we meet with them, right? And they did do a good job in terms of rent control. I will say there is enough room to operate effectively in Washington.
As I've seen it, it is depending on the terms of the lease and kind of if it's a year lease or if it's month to month, there are limits to how much rent can be increased.
Yeah. So you have like 7% plus CPI. So it varies a little bit, but let's say it's like a little over 9%.
Okay.
That's a pretty substantial increase. A 9% a year increase is actually a lot.
That's a lot.
So we've never factored that into our business model
but
to begin with.
If let's say you find a Class C kind of building that's got Class B potential,
right?
Like it's been let go for a long time.
Mm-hmm. Mm-hmm.
And, maybe in this, you got a studio 1-bedroom that's $1,200.
Mm-hmm.
But if you can come through and put in appliances that work and fix the plumbing so it actually, because we're talking, right?
Yeah.
And so now like market rate in that unit might be $1,800. That's a 50% increase.
Right.
Relative to the market, though, it's in line.
Right.
Do rent controls prevent you from doing that?
So this is tricky. I would say, first of all, we underwrite a lot of deals. We get sent deals every single day. There's not very many in this size of building where the rents are that far behind to where over a 5-year hold, if you really did push 9% for 5 years, you would hit your numbers. Like finding something that's below that is, they exist, but this is where some operators get really hung up to, or people in general, wanting to find that unicorn deal. You don't have to do that in real estate. Like there's a lot of great ways to make money in real estate, and you're not going to scale if you're looking for this crazy unicorn.
So that scenario that I just said is probability 10%.
Pretty low,
Yeah.
at least across the whole building.
Sure.
Where it sometimes does apply is there might be a unit or two.
Oh, sure.
Where, all the units are different pricing. Someone could have lived there for 20 years and maybe they're getting a really good deal. So I'm not saying that it doesn't matter. I would just say holistically in the scope of a big building, there's not so many operators that it's misleading when people think there's these landlords out there that just haven't raised rent in 20 years.
Mm-hmm.
That's not really true. Even the Nepo kids, and the people who are not super focused on squeezing every penny out of their deal, they generally keep up with market rents, which is a good thing, because if you don't and someone new comes in and buys that building, you have set your people up for failure.
Yeah.
They are not actually equipped to live in the neighborhood they're living in. Then they can't keep up with the way that costs increase. So I would also say that's not really doing anyone any favors.
Mm-hmm.
It's also super, super rare. But then you have to start increasing the rent. Like our business plan is to come in and make the units nicer, right?
Yeah.
Like there are a lot of buildings that have been overlooked. I'm not going to call people slumlords or anything, but like not really well cared for units. They need some love. They need some updates. You come in and you raise rents. Now you can only go up a certain amount, and you can't get that new market rent until you get the person to move out and renovate their unit. You can't just say, I want to renovate your unit. You're going to move.
But when the person moves out, then you have a new lease, and you can write that new lease at any number.
Yes.
Yeah.
So that's what you want, quite frankly, is you have a really old unit. Sometimes they haven't been touched in literally 40 years. You need to renovate it. You do need that person to move. And then you set the standard for what that rate should be. If they keep just signing at the renewal too, that helps your CapEx plan.
Yeah.
And you have someone in there who's apparently willing to pay market rent without getting the renovations. We also have people in our buildings that will see a new unit and will be in an old unit and will move to the new unit. And that's great too, because they're like, I want that one and I see what you've done to it. I like it. I'll move over there and then we can renovate theirs. So, that's always beautiful when that happens.
All right. Now I got to ask you about LinkedIn.
Oh, yeah.
Okay. She says, oh, yeah. So you, when did you start putting content out about Veritas?
I believe it was 9 months ago. I think I recently went back and looked at my first post. I might have posted like one or two things when I left my tech career to announce my transition.
But you have like top tier content.
Thank you.
And I say this as a connoisseur of social media content. Like I started watching Gary Vee, I don't know, 10 years ago, maybe more. And just watching from the sidelines, trying to understand, what is this? And you just come out with fire. It's good.
Thank you. I love hearing that, because it does take work to be a content creator, right? And that is a big part of my role, which I probably should have maybe started with, but my business partner is the one who has the majority of the experience with real estate investing. I was working in tech 2.5 years ago, and I sort of fell into this. I was a bit lucky, really. I was looking at getting into real estate investing, thinking I was going to like buy a duplex or something. And someone said to me, you probably shouldn't do that because you have no idea what you're doing. And you're talking about
wise counsel. It's good to have wise counsel.
And I'm now at a mature enough age where I can say, you know what? That's a great point that you're making. I would love to talk to your friend who apparently works in tech and does this on the side. And so I got connected to Alex, and it was around the time that he was being told to go bigger with real estate. And so blah, 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 back to the LinkedIn content. Like it started a little bit also to educate myself. I mean, I'm 2.5 years into real estate investing, but I took on the bigger role when it comes to capital raising and marketing.
Mm.
And because I have experience doing that in my tech background. So I was thinking about what are the organic ways that we can just get our name out there. And Hermosi says, he has some quotes about, like basically to the effect of no one knows who you are. And if no
Yes.
one knows who you are, then you should spend 4 hours of your day making sure people know who you are. And that hit me because we'd probably raised $4 million or something from our network, and nothing was advertised. It was all word of mouth and events. And I was like, it seems like we're starting to hit a wall. It's getting
Oh,
harder
yeah.
to fundraise just like, can we truly scale to where we want to be if we don't do any advertising and we
Yeah.
just rely on our network? And the answer was no. I was like, we're not going to raise 20 million bucks a year.
We share this. My business partner, whom we both know, this One Accord was largely built on his personal network,
Right. Yeah.
and that's a large personal network.
Right.
It's hard to meet somebody that doesn't know somebody that knows somebody that knows Jeff.
Mhm,
There's 3
mhm.
degrees from
From everyone
Yeah.
in all of Seattle.
Yeah.
Or Washington. Yeah.
or Nashville, Austin. Yeah.
Yeah.
And yet it has its limits.
Mhm,
So he will say, I think I've got 9,000 connections on LinkedIn and I've met every one of them. That's awesome. But it's still only 9,000 people.
mhm,
Right.
mhm.
And I think in my market, my TAM, if we use this total addressable market, is easily 100,000 people in the US.
Right.
If I just say, kind of that 55 to 70-year-old demographic of owner operator, businesses in the US, that's easily 100,000.
Yep.
And the fact that you call Hormozy by his single last name, you're an insider here, right? But Hormozy's right.
Yeah.
None of those 100,000 know who I am
Yeah.
or what we do.
Right.
And so you lean in and you say, okay, here's our network. Our network trusts us. They've given us $4 million. We have something here. We have a proven model.
Mm-hmm.
Let me just go tell everybody.
Yep.
And you tell them straight. Like your content is like, it's not controversial, but it's also not soft.
Right.
Like,
Right. Yeah.
Yeah.
Maybe I inherited that from Alex because you touched on it earlier where I'm like, we're not the most flowery, feel good. I think part of Veritas is really shooting straight with people.
Yeah.
Like with investors. I want them to know that that's not just like something that I'm saying, that I practice that in my life.
That's good. So because I've known you for years and I've known Alex, I don't know, is years right? But anyhow, for
Yeah,
a while. And
probably.
we've had,
Yeah.
we've done business
We've
deals
done business
together.
together. Yeah.
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 So what I can say is that there is congruence. This is a
Mhm.
really important word for me in relationships, is that there is congruence amongst or between behaviors. So how you show up online is how you show up
Mhm.
in business, is how you show up in relationships, and they're all congruent.
Yep.
It's an important thing. I don't know.
I love that. I think it is very important to
Mhm.
be congruent across all. I don't ever want someone to say, you sound like this on social media and then I want my social media to be the real me.
Yeah.
And I try to give also some personal nuggets of, who I am to earn trust with people and give them insight to why me as an operator, to some extent, this business owners are selling themselves. You're
Yes.
selling the deal, but you're also selling yourself. So that's our track record, and then just who we are as people. And are you going to get the straight information when things aren't going well? And we're very dedicated to our mission too. Like when we're presenting, sometimes someone will raise their hand and say, well, I've heard really good things about Boise or Chicago. Would you ever go there? And it's like, no.
Yeah.
End of story. Like we are Washington State investors. This is our thesis. If it's not in this buy box, then we don't do it. Like,
Yep.
this is our skill set, and never vary. There's a lot of real estate operators and that are chasing the shiny thing. Like, I want to do assisted living. I want to do RV parks. Well, you're not an expert in anything. And I would say for sure when you're investing with someone, make sure that if they are doing that they have a really long track record and understand the business model and the market and their specific region, all of that. But
Does
yeah.
does Veritas, is that the I'm thinking Greek or Latin? Is the root
For
in there?
truth.
Truth.
Yeah.
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 That's
Well,
good.
funny. Yeah. The name is kind of hilarious. We can cut this out if we need to because it's not a very good story. But, when you're starting a business, you kind of just see what domain name you can get.
Yeah.
I must have tried 1,000
Yeah.
names for our company. And anyway, I don't even know where Veritas, like how I saw it, but I was like, I do think that truth is something that we want to embody. We are really honest. We are truthful with our investors. We would never do anything shady. So at the very least, at least you have that. I'm not going to sit here and say I'm the best multifamily investor of all time, but we're also transparent and honest, which unfortunately for this industry and alternative investments is not always true. So you really do need to get to know your operator. And I think LinkedIn is a format in which people can get to know me at mass. Like, I can only do so many phone calls and I can only educate you so much during that 1 hour call or that 5 minutes that we chat at a meeting. But you can go to my LinkedIn page and go do research from yourself too, that like I'm really thorough with citing my sources. I don't just throw things up there's people that put some things on LinkedIn to where I'm like, I would like to know where you got that information, right? And I try to be like, it's not just me. Like, here's where this was published. Here's who did the research. Go look at it yourself, and just really empowering people to do their own research so they can get smarter about where they're putting their money, especially in alternative investments, which can go sideways. So can the stock market, so can crypto. So it's not,
Yeah.
it's all kind of like you said earlier, investment comes with risk. But there are ways with syndications. I think people want to know their operators. So that was kind of where I was at, was like, people need to know me and they need to know Veritas, and then they need to understand our thesis. And so it all kind of circulates around that.
It works.
Yeah.
And it is the case that you and Alex are the ones who are not just figuratively, but literally writing those checks, those 6%, those 9% checks, and so knowing you and the ability to know you, and you host events, you host informative events, get to know yous, and you host, and your investors are going to be with you. They're going to be meeting you. I imagine some people don't meet you.
Yeah.
That, they just, their risk tolerance is such that, like, no, I think I buy it. Here's a check, but if they want to, they can. Yeah.
I think it goes back to, I think it was the first question you asked, what is your vision or your goal?
Yeah.
And I really do want a group of a couple hundred people, is probably the answer, that really buy into the thesis, understand it, support it, like it, want this type of investment. It fits what they're looking for, and really just serve those people well. And hopefully they continue to 1031 with us and grow their money, and we can manage their real estate portfolio. In addition to the syndications, we do have now several clients that we're managing their entire real estate portfolio. So millions of dollars, and serving as kind of a mini family office. They're tired of doing it themselves. They've made a lot of money on it. Some of them are talking about how to transition it to the next generation. So helping people set up that structure. And I think it's about knowing our investors. It is a really huge responsibility to manage people's money. So I do not take it lightly. And I also do like knowing those people and having a relationship with them. Some of them have turned out to be really good friends. Like just in the 2 years that we've been around, they've really supported our business, shared with their friends, and advocated for us. And that's the bigger, that is the bigger thing, more so than LinkedIn. Although LinkedIn has done really great things for me, and maybe some of those people will turn in to this, but nothing beats a referral.
Yeah, that's the truth. I was half tempted to encourage you to duplicate your content on X, but I don't know if I'd wish that on that's a platform that I've leaned into.
Yeah.
And uh, it's proven well for me.
Okay.
And very interesting. I was in Sundance, Utah 2 weeks ago.
Cool. Yeah.
And Ariana and I were having dinner with some friends, and I stood up to leave, and a guy from another table comes over and goes, Are you Nick? Are you Nick from X?
That.
And
Yeah.
and he and I had communicated on the platform, but there's a little tiny picture of somebody, and
Yeah.
the social networks allow the world to get really small really fast.
Mm-hmm.
But then the conversation, the takeaway was, hey man, next time you're in Utah, let's get together in person
Mm-hmm.
and build on that relationship, right?
Yep.
So going back to Hormozy, there's hundreds of thousands of people here that just don't know who we are. So if we can use this platform to introduce ourselves and then build a relationship with maybe those couple hundred that you want to build with, over time.
Yeah. I would say maybe more importantly too, I have a post teed up about this because I posted about getting new investors, very important. I've also connected, this might be more important, with some other local operators that were willing to actually communicate and be transparent, more closed door conversations, not necessarily stuff I would be posting about, but networking with people that are helpful to my business, not necessarily by bringing investors or in a way that I can monetize, but relationships where we are talking about things that it's hard to find people who do this job. We're kind of a rare breed. There's not tons of syndicators out there and that are our size and in our thesis and in our market, very, very limited. So, and then finding the ones who don't see it as competitive and are like, well, I'd love to learn from each other and share insight is pretty cool. So I would say that's the other thing about LinkedIn is I think there is an opportunity to make some genuine connections that are educational in a different way. That's also very powerful. And I am curious about X because I've asked Claude multiple times now, should I do this on X?
Yeah.
And it keeps telling me just stay focused on what you're trying to do on LinkedIn. And I'm like, okay, I don't know. I'm literally not on it, but I am curious about that.
Your content would play well
Okay.
in what is known as money Twitter.
Okay.
So there's fitness Twitter, there's relationship Twitter, there's money Twitter, there's crypto Twitter.
Yeah.
Funny that you mentioned naming Veritas was like looking for a URL.
Yeah.
So right at the end of January 26, I'm going down a whole different rabbit trail. I'll bring it back here. Right at the end of 26, there was the emergence of what was then known as Claudebot.
Okay.
And you just said Claude, right? So Claudebot is CLAWD.
Okay.
And the mascot is a lobster.
Okay.
And it was a play on words for kind of a startup idea that Anthropic, because it exploded, Anthropic immediately sent a cease and desist and said, you can't use that name. They politely asked, right? And so the creator of Claudebot then changed the name of his little side thing into Moltbot, which molting is something that a lobster does.
Yeah.
Okay.
Yeah.
Horrible name.
Yeah.
But he had to come up with it on a whim because he was under pressure.
Yeah.
And then all of his audience was like, what are you doing? So then he renamed it Open Claw, CLAW. in 3 days, his business that was exploding changed names because of that experience of like, and he tells this story about how difficult it was to come up with a name.
Yes.
And the only
Yeah.
reason I know about this is
Yeah.
because of X, because I'm on that platform, and I find that I actually just posted today on LinkedIn a picture of people sitting in a movie theater popping popcorn. I said I'm eager to see how LinkedIn reacts to the OpenClaw and Moltbook stuff that's going on,
Mm-hmm. Mm-hmm.
because it's a wildly fast growing phenomena, and I feel like X is kind of at the bleeding edge of everything.
Yep.
Okay, coming back from the rabbit trail,
Yeah.
this money Twitter corner,
Yeah.
you will find a lot of your people there. Yep.
I'm interested, and you learn a lot from social media. I didn't even
Mhm.
touch on that, but now all the posts that everything that appears on my feed is from other operators
Right.
having really interesting conversations and finding little operational tweaks. And there's a lot of gold in there. Some of it that not even by meeting someone that helps my business. So I think Twitter is
Yeah,
a good place for that too. I like the All In podcast, and I feel like they're all
so do I.
tweeters. So,
It's there.
or do
It's
we
there.
still, we don't call them tweeters anymore, do we?
Well, it's X, and you do a post on X, but it's a tweet. I mean, you just
Yeah. See,
it
I'm
is.
very not in the Twitter game, but
Yeah.
I also like the idea too of I'm curious if doing some more Twitter like stuff on LinkedIn, like basically just really short, if it would translate.
In my unprofessional opinion, like my novice opinion, I think that you've got LinkedIn just dialed. I
Okay.
wouldn't recommend any changes as a
Yeah.
consumer of your content.
Love
Like,
that.
nailed it. And I think in its current form, it fits over on X.
Yeah.
Even the long form.
Okay.
And you
Cool.
could get some short stuff there, but I think the long form, Twitter evolved to long form.
Okay.
Actually.
Well, I'm going to have to check it out.
Yeah.
I think social media is a great way to drive eyeballs.
And I have flown around the US. So I'm going to say Vegas, Austin, North Carolina, Atlanta, Indianapolis, Denver. I'm losing some. All of those
Mm-hmm.
were flights to meet someone in person that I met through X
Whoa.
and in some kind of a business relationship arrangement.
Wow.
Yep.
Okay.
So,
well, there you have it. I guess I'm getting on X after this. See me
there we
on
go. Here she comes.
on
Elon.
X. I'm like, what's my handle going to be? Should have come prepared so I could make this announcement.
Yeah.
But no,
We'll release it.
it's very good. I appreciate the compliments on my LinkedIn because it's fun to do. Lots of insights, beneficial. So I'll definitely keep creating content there.
Do it.
But yeah, I've been exploring with, what are the other ways to raise capital, drive
until
business.
you get on X, people can find you on LinkedIn. Like if there's,
yes,
we wrap up an episode with like, so how does somebody find you, Lauren?
Yes.
And I think these days, like if somebody's been watching or listening this long, they're definitely interested in the content.
Yes.
And they've probably already Googled you.
Yeah.
They've probably already gone onto LinkedIn and said Veritas Equity Partners and Lauren, and they found you. But how does somebody find you? What's the best way to get in touch with you?
VeritasEquityPartners.com. There's a contact us form.
Yeah.
That goes to me. And LinkedIn. Lauren, I think it's /Lauren Veritas Equity Partners.
Yeah.
I should probably
here again. I asked asked this question if somebody wants, and they're like, if somebody can't find me on Google, then I don't want to work with them.
You'll definitely be able to find me, Lauren Rogers, on on LinkedIn
He-
with Veritas Equity
He was
Partners.
he was an
Pretty
attorney,
confident.
this employment law attorney
Yeah.
that I was talking to, and he was just like, "Yeah, if they're not smart enough to find me on LinkedIn, then they shouldn't be my client." It's
Yeah.
like, whoa, okay, way to screen. But that is
Yeah.
that is the way the world is. Lauren, thank you so much for hanging out in the Value Factory,
Yeah.
sharing thoughts. Appreciate it a ton.
This is awesome. It's a wrap.
That's a wrap.
Cool.